Have you ever stopped to think if that good mood you're in could actually, change how you invest your money? Or if a really bad day at the office has some kind of hidden ripple effect on your entire financial future? We tend to think of our feelings and our finances as being in two totally separate worlds. But what if they're not? What if they are deeply and scientifically connected? So let's just ask it straight up. Does your mood control your money? The answer, it turns out, is way more complex and honestly more fascinating than you'd probably guess. And we're not just talking about, a little retail therapy when you're happy or pinching pennies when you're worried. No, we're talking about a fundamental link between your inner state of mind and how much financial risk you're willing to take on. And that's exactly what we're going to break down right here. A brand new study has uncovered this critical threshold, a kind of psychological tipping point where our level of happiness can dramatically reshape how we make decisions with our money. So where does an idea like this even come from? I mean, we all kind of know our emotions can sway our choices, but can you actually measure that effect on something as serious as an investment portfolio? Well, for years, researchers have had a pretty good idea that happy, optimistic managers tend to make better corporate decisions. That makes sense. But when it came to regular people, like you and me, that connection was a total mystery. As the study puts it, the relationship was unverified. It was a puzzle just sitting there waiting for someone to solve it. So to crack this code, researchers had to launch this massive investigation. Think of it like a detective story for our financial psychology. They needed a ton of data, they needed clues, and they really needed a way to spot a pattern that nobody had ever seen before. And the whole investigation was published in the journal Finance Research Letters. The researchers took a super deep dive into a huge set of data to hunt for the answers. Okay, so their main source of clues was the China General Social Survey. This thing gave them a window into the lives, the finances, and the feelings of over 11,000 people. So we're not talking about a small focus group here. This was big data analysis, looking for those hidden clues on a massive scale. All right, let's dive into the clues they were tracking. Now, don't worry about the weird code names on the left. What's important is what they were measuring. Obviously, they looked at happiness. But for risk tolerance, they did something really clever. They looked at who wasn't buying insurance. The thinking is, if you skip insurance, you're probably more comfortable with risk. They also tracked who was buying stocks, how much control people felt they had at work, and of course, the usual stuff like income and education. These were all the puzzle pieces they needed to see the big picture. And after sifting through all of that data, they found it. A single number that changed everything. The one critical clue that unlocked the entire mystery. What they discovered was that the connection between being happy and taking financial risks, well, it wasn't simple. It wasn't just a straight line where the happier you are, the more risks you take. Nope, the data was telling a much stranger and way more interesting story. This is it. This is the magic number. On a happiness scale from 1 to 5, 3.8 was the tipping point. It was the exact score where people's financial behavior just fundamentally changed. Now, this is where it gets really cool. You can actually see the evidence with your own eyes. Don't worry about the technical stuff on this chart, just focus on the story it tells. See that trend line? It's not smooth, is it? Right at that vertical line marking the 3.8 happiness score, there's a distinct jump. The pattern literally breaks and leaps upwards. It's a visual confirmation of that sudden, dramatic shift in behavior. So here's the bottom line. Below a happiness score of 3.8, the link between your mood and your risk-taking is pretty much chaotic and unreliable. But the moment people cross that 3.8 threshold, the relationship becomes stable and positive. For these happier people, every little bit of extra happiness steadily and predictably increases their comfort with taking financial risks. Okay, so finding this tipping point is one thing, but it just brings up an even bigger question. Why? Why does it even exist? Let's get into that, because the study didn't just find the what, it also uncovered the why. So, in science speak, they were looking for the transmission mechanism. Basically, what's the engine that actually connects our feeling of happiness to our investment decisions? And the model the researchers built revealed something absolutely fascinating. They found that happiness itself isn't the direct cause. It's more like a channel or a conduit. The real driver is what creates that happiness in the first place. It turns out, not all happiness is created equal when it comes to your money. And this right here perfectly illustrates the chain reaction they found. Let's just walk through it. It all starts on the left, with having more autonomy and control at work. That feeling of being in charge leads to higher happiness, but it's a specific kind of happiness, one that comes from empowerment. And that is what boosts risk tolerance, which finally, all the way on the right, changes our investment choices. It's a clear path from your job right to your portfolio. And the data backs this up perfectly. I mean, look at this. When the researchers grouped people by how much control they had at work, this crystal clear pattern emerged. The folks with full autonomy, their average happiness was 3.9, comfortably above that 3.8 tipping point. But for people with no autonomy, their average happiness dropped all the way to 3.71, falling just below that critical threshold. So after this whole deep dive into the data, what does this all really mean for us? How can we apply this to our own lives and our own money? Well, it really boils down to three crucial takeaways. First, there's the 3.8 rule. There seems to be a specific level of happiness that unlocks a more stable, positive attitude towards financial risk. Second, the autonomy engine. That feeling of control in our work life is a key factor in actually reaching that happiness level. And third, our mood isn't just random noise. It's an active and even predictable factor in how we manage our money. And the real-world implication of this is just profound. It means that finding a job where you feel empowered and in control isn't just a career goal, it's a financial strategy. Your day-to-day satisfaction at work has a measurable and direct link to your long-term financial behavior and ultimately your future wealth. And that leaves us with one last big question to think about. We spend so much time and energy analyzing stocks, balancing our budgets, and managing our portfolios. But if our own happiness, especially the kind driven by a sense of control over our own lives, is such a powerful financial force, well, maybe we should start managing our own well-being with just as much care.